Hello, and welcome to this week's episode of Retire with Oakleaf. My name is Matt Bithlet. I'm a certified financial planner and an enrolled agent here at Oakleaf Wealth Management. Today we really wanted to cover topics that affect our clients in regards to year-end tax planning. And this is going to be in conjunction with some changes that were enacted via the One Big Beautiful Bill, the new tax bill in July. And it's also going to round out with some additional updates that were issued a few years prior, but are now coming into effect in 2026. So let's begin. So the One Big Beautiful Tax Bill was enacted in July of 2025. There was a little bit of confusion regarding what was effective for 2025 and what was effective for 2026. And I think more importantly than that, who it affected. There was a lot of confusion around income thresholds that start a phase out, and some folks get deductions, some folks don't. So just want to start very, very basic today. In another video, we will be talking about how we actually assist clients with taking advantage of these deductions and implementing them in their planning. But again, today, keep it simple. We're going to be high level in terms of facts. So the first thing I wanted to highlight is the increase of the SALT cap. So for those of you who haven't heard of the SALT cap, it is the state and local tax deduction that is available to taxpayers who itemize. So in years past, this was capped at $10,000, where if you had real estate taxes, local, state, and sales taxes that amounted to more than $10,000, you could only claim 10. So a lot of folks, I believe the percentages, it's in the range of 90% of Americans take the standard deduction rather than itemize because of the fact that they could never have enough mortgage interest and charitable contributions, medical expenses that exceeded the level to itemize. Where they've changed this cap from $10,000 to $40,000 if you make under $500,000 of income for the tax year. So without getting too complicated, if you go above $500,000 of income, then it starts to phase out. But for today's purposes, again, if you make under $500,000, whether you file single or you file taxes jointly, the cap's going to be $40,000. So that could create some more planning opportunities for folks who have these expenses that qualify as itemized deductions. So that was a really big change and a really impactful change. The second one I wanted to talk through was the enhanced senior deduction. So this is what was talked about when it was marketed as no tax on Social Security. And again, there was a little bit of confusion about who received it and why they received it and what the income thresholds were. So high level, if you are over age 65, you receive the standard deduction, which was increased for 2025 during the bill. You receive an additional standard deduction that is based on being over 65. It's $1,600 per taxpayer. This senior deduction is on top of those two, and it allows people to be eligible for $6,000 of additional deduction, again, per taxpayer. So if you file single, it's $6,000. If you file married filing jointly, then it could be $12,000 of additional income that's not taxed. As with anything in the tax realm, there's always a caveat. In this case, if you go above $75,000 of adjusted gross income and you're single, and above $150,000 of adjusted gross income filing jointly, then this deduction starts to phase out. Again, if you have income below those thresholds, you have the ability to take advantage of the full deduction. If you go above those thresholds, start to phase out. The deduction completely phases out once you go above $175,000 of adjusted gross income for single filers and $250,000 of adjusted gross income for joint filers. So if you're near these income thresholds, in the middle of them, I really do encourage you to reach out to your tax professional, your financial professional, your team behind you to understand how you could potentially take advantage of these in your own situation prior to the tax year ending versus knowing you are eligible for them in April when not too much can be done from a tax perspective at that point. The third thing I wanted to touch on is another change in the One Big Beautiful Bill, and I wanted to highlight this last because I do think it's pretty cool, and it is a unique situation, but there is this section of the tax code that references qualified small business stock. And basically what that means is, and it's had a few iterations over the years, but when you have qualified small business stock, which under the qualifications, simplifying them, your company is a C corporation, so you're not a standalone LLC, you're not filing as an S corp, you're a standalone C corporation. The stock has been held for longer than 5 years, and prior to this One Big Beautiful Bill, the assets of the company were less than $50 million. As long as you met those qualifications, you could sell your company and you had the potential, depending on when the stock was issued, to have between 50% and 100% of that capital gain excluded from income taxes, which can be extremely, extremely impactful if you're selling a business that you've built and nurtured over many, many years. The One Big Beautiful Bill raised this exclusion from $10 million to $15 million, and they adjusted the asset level of the company from 50 million to 75 million. So these were good changes, but again, with taxes, there's always a caveat, there's always a catch, there's never a free lunch. It has to be stock that was issued after July of 2025. So this is not something that applies to company stock that was held or issued prior to July of 2025. It has to be from July of 2025 and after. So you would have to, in theory, hold the stock for 5 years after this, still meet those qualifications in order for you to be able to take advantage of this. But again, another really impactful planning strategy that if this sounds like your situation, or it sounds like it could be your situation, you're thinking about selling your business in the next couple of years and you have a current entity election, it's not a C Corp, may be worth speaking with your tax team and your financial team to see if it makes sense to potentially take advantage of any of these sections in the tax code. So again, high level here, we talked through some changes that were enacted in the One Big Beautiful Bill. We walked through a piece of legislation that was put in place, that was mentioned in the Secure Act 2.0 that is now coming to fruition, being effective in 2026. And we also talked about qualified small business stock that was already existing, but they have issued changes in the One Big Beautiful Bill. Again, these are areas that we see impact our clients each and every day, and we really try and be proactive in engaging their team and engaging our clients to make sure that we're putting our best foot forward to ensure that we're being as efficient as possible. As I mentioned, in our next video, we will take 2 or 3 of these topics and really highlight how we're helping our clients in real time with these situations and how important it is to have your tax team and your financial team linked together from a communications and collaboration standpoint. But in some cases, if you can have it all under one roof and house, it can make it that much more efficient. So again, my name is Matt Booth-Follett, and I look forward to seeing you on the next episode of Retire with Oakleaf.